Welcome to this explainer. It's kind of an open secret in the finance world that even the most seasoned traders often hit a wall simply because they forget their foundational mechanics. So today, we are completely demystifying the markets. We're going to give you a highly structured, super actionable roadmap to transition from just having a theoretical curiosity to actually engaging in active, disciplined trading. Whether you're looking to build long-term wealth or you're just fascinated by short-term market dynamics, understanding the precise mechanics of trading is absolutely vital. We're going to break down exactly how this massive digital marketplace works using the most direct information out there.
Okay, let's take a quick look at our roadmap for today. We'll kick things off with stock market fundamentals, then we'll move into choosing the right broker. After that, we'll cover the top analytical trading tools at your disposal, outline the exact 5 steps to start, and finally, we'll lock in the absolute most critical part of this whole thing, the golden rules of risk.
All right, Section 1, Stock Market Fundamentals.
So, right off the bat, let's tackle a question that honestly trips up a lot of people. Most folks use these two terms interchangeably every single day. I mean, if you turn on any financial news channel, you'll hear them thrown around in the exact same breath. But is there actually a real technical difference between a stock and a share?
Well, it really just boils down to precision. Stocks is your broad umbrella term. It refers to general equity ownership across one or more corporations. So you might tell a friend, hey, I own stocks. But shares, that designates the precise individual units of ownership in one specific enterprise. You wouldn't say you own 50 stocks of a company, you'd say you own 50 shares of that specific company. It's a small technical difference, sure, but precision really matters when you're mastering the mechanics of finance.
Moving a bit deeper, really wrapping your head around equity ownership means understanding 3 core pillars. First up is market capitalization. That's basically the total monetary value of a corporation, which you calculate simply by multiplying its total outstanding units by the current price. Second is liquidity. High transaction volume is super important here because it ensures tight bid-ask spreads. That means you can execute an order instantly without dealing with slippage or adverse price movements. Think of liquidity like the ease of selling a highly demanded gold coin versus trying to quickly sell a massive piece of real estate. And finally, regulatory compliance. Bodies like the SEC in the US or CySEC in Europe enforce strict reporting rules. They're there to prevent corporate fraud and ultimately to protect you, the retail consumer.
But ultimately, why are we even doing this? To grow our wealth, right? And that return is generated through 2 primary mechanisms. The first is capital appreciation, which is just a fancy way of saying you sold your equity at a higher price than what you bought it for. The second is through periodic dividend payouts. That's when the corporation actually distributes a portion of its net earnings directly back into your pocket.
Let's move on to Section 2, choosing the right broker.
Because here's the thing. Not all brokers are created equal, and your specific trading style completely dictates the toolkit you need. If you're a risk-averse beginner, AvaTrade really stands out because they offer fixed spreads and are strictly regulated by the Central Bank of Ireland and ASIC. But if your focus is more on long-term equity and ETFs, XTB is fantastic. They offer 0% commission on stocks using their own proprietary platform. On the flip side, if you're a really active algorithmic trader or a scalper, IC Markets provides those raw ECN spreads you're looking for. And for the institutional-grade equity traders out there, FP Markets offers direct market access. The big takeaway here, you absolutely have to align your platform with your specific strategy.
All right, Section 3, Top Analytical Trading Tools.
We have definitely come a long way from guys shouting orders in a crowded trading pit. Today, everything you need basically lives in a few browser tabs. TradingView is essentially the industry gold standard right now for interactive web-based charting. It gives you over 100 built-in technical indicators, custom Pine script creation for building your own strategies, and access to a massive global community of ideas. But hey, don't sleep on broker academies either. Tier 1 brokers often provide some incredible, structured self-paced courses. They cover the whole shebang, from technical chart patterns to macroeconomic indicators, and perhaps most importantly, trade psychology. Now, if you're debating between specific execution platforms, you're really looking at the evolution of an industry standard. MetaTrader 4, or MT4, is fantastic. It's reliable, it's beginner-friendly, and it's heavily focused on forex trading, while supporting automated expert advisors. But MetaTrader 5, or MT5, really expands your horizons. It's a multi-asset platform, which means it supports stocks, commodities, and futures right alongside forex. Plus, it gives you more timeframes, advanced algorithmic order management, and a built-in economic calendar. So if you plan to branch out and diversify across different asset classes, MT5 is clearly the way to go.
Moving into Section 4, 5 steps to start. This is where we take all that theory and turn it into an actionable, systematic process. Doing this builds your operational consistency before you ever risk a single real dollar. Step 1, like we talked about, is selecting a fully regulated broker. You want to make sure your funds are held safely in segregated accounts. Step 2 is knocking out your KYC identity verification. But step 3, that is your true filter for longevity, opening a virtual practice account. This is where you practice order execution, get comfortable with your dashboard layouts, and rigorously test your risk management parameters using fake money. Only after you are totally comfortable there do you move to step 4, funding your live account. And finally, step 5, executing your very first real transaction after thorough analysis.
And that brings us to Section 5, the golden rules of risk.
I really want to slow down here because this is the absolute most vital part of our entire journey. How do you actually survive in the market long term? Well, this single metric right here is your ultimate shield, 1%. The absolute golden rule of position sizing dictates that you should never ever risk more than 1 to 2% of your total account equity on any single setup. It honestly doesn't matter how confident you feel about a trade. Sticking strictly to this 1% rule is what keeps you in the game when you inevitably hit a losing streak.
But that 1% rule isn't your only line of defense. First, you have got to always utilize automated stop-loss orders. This instantly liquidates a losing position at a pre-calculated threshold, which completely prevents those catastrophic portfolio drawdowns. Second, diversify your capital across multiple non-correlated sectors. Spread your exposure across tech, healthcare, energy, so if one sector suddenly tanks, it doesn't wipe out your whole account. And finally, maintain an emotionless trading log. Document every entry reason, every risk-reward ratio, and the final outcome. Doing this helps you ruthlessly cut out those impulsive, emotional habits.
Our source material sums this up beautifully with this idea: mastering the stock market doesn't require a fancy degree in finance, and it definitely doesn't require thousands of dollars in upfront tuition. What it actually requires is consistency, structured guidance, and deeply disciplined risk management. Sustained profitability is almost never about predicting the future with absolute certainty. It is entirely about your portfolio allocation, your behavioral discipline, and executing your strategy without letting your emotions take the wheel. So, as you get ready to open that first virtual practice account this week, I want you to honestly ask yourself, is your first trade going to be driven by a gut feeling and impulsive emotion? Or will it be executed with strict risk-managed discipline? The digital evolution of the financial markets has handed you institutional-grade tools on a silver platter. The power is completely in your hands now, but your success? That hinges entirely on the rules you choose to follow. Thanks so much for hanging out with me for this explainer, and happy learning!